Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Gold Stock Analyst editor John Doody and his partner Garrett Goggin.
And today, first, we'll talk about economists and recessions and whether it means anything at all for investors.
And remember, if you want to get in touch with us, send a note to feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. One of the best quotes I've heard over the years about anything in finance is, all the world's economists laid end to end couldn't reach a conclusion. I like to cite that whenever anybody brings up what economists think. And I thought of it this morning because Bloomberg has this article that's called "Recession Calls Keep Getting Pushed Back, Giving Soft Landing Believers Hope." And it's all about all these economists who basically have been calling for a recession to begin in 3 months, for a year or something. I mean, for at least since last September. So, here we are, we're however many months, 5 plus 4, 9 months out, and no recession yet. And they're still predicting 3 more months, 3 more months, 3 more months. And, consumer spending is growing. Housing looks better than it did a month or two ago, and other things. And, the GDP is rising. So I don't know. Are we ever going to get a recession? Are they ever going to stop calling for one? I don't know.
There's a couple things that come to mind here for me. One, could we already be in a recession just without that high unemployment number? So maybe they're right, the economists. They just don't know that they're right, or are using different criteria than is practical. What's the point anyway, right? Like people have been waiting. I think that's another thing. All these economists and people in general have been saying, "Oh, the recession. When's it going to come?" At some point, it's like a self-fulfilling prophecy. If you're expecting it to come, which we've seen already with the Fed hiking rates and just the market responding to that, and the bank crisis we've seen. So
yeah.
When I see economist predictions, I generally ignore them completely, other than to take them with a heavy dose of skepticism.
Yeah, and the article says, of 27 forecasters surveyed by Bloomberg in early May, only 5 said they didn't expect the U.S. economy to slip into a recession sometime over the next year. But then there's one Morgan Stanley economist, Ellen Zentner, said, "We all hate that term, 'this time is different,' but we have not seen this dynamic before. This is unique." And, I think she's talking about the combination of, robust labor market, wage growth, excess savings accumulated during the pandemic, and consumer spending rising as a result of that. So, I don't know. Basically, we have an economist. We have most economists saying recession, and then we have this one who is saying, putting the cherry on top and saying this time is different. So maybe we don't get a recession, and that's sort of where I am. I was like, I've been warning people that I thought the market was in danger of an imminent decline. I still think that's true. But whether or not there's a recession or, worse inflation, I'm less convinced that I have any clue of that. But I'm starting to throw recession just completely out the window, because inflation, like PCE inflation, basically been hovering in the general ballpark of 5% for like a year. I mean, it's lower now than it was. Like, it's a slight downward slope, but still it's in the same general ballpark. And then we saw Canadian inflation tick back up. And they've paused rates for months. right? They haven't raised in months. So who knows? Maybe what we're seeing here is just the persistence of a level of inflation that folks would have thought we might not have all this time.
Right. And what, that's what I think is more important than whether you officially, you know, call a recession or not, although that matters to kind of sentiment in the market as well, and just, you know, the country in general. You know, if people think we're in a recession, that and we're calling it a recession, that has an influence on things too, which is why I think all the politicians in 2021 were trying to avoid calling that a recession, which if we remember was 2 quarters of negative GDP growth. And so you could argue that we already had a recession. That was more based off of, I think, the high inflation of that time, which led to all kinds of different bottlenecks and supply chains and inventory changes and all of those things for businesses. And that basically, you know, that was an inflationary kind of recession to me, the peak, that part. Now we're getting to the part that might be a recession based on the reaction to fighting the inflation on the part of central banks and the consequence of that. And so my base case personally through all of this is inflation is just going to be higher than people think. And I'm with you that maybe there isn't a quote unquote official recession, but that doesn't mean the economy is going to be great either. I think we're seeing that reflected in this sideways market for the last however long you want to say. It's been almost perfectly sideways for about 6 weeks, even with a little volatility from the end of the bank story. And you could go back to the last summer. We're approaching, you know, a year of if you know, you could pick dates. You know, it's a little unfair to pick out dates, but my general feeling is this inflation is just going to be higher than 2%, probably higher than 3%. I'm thinking more and more, and the Fed's just going to kind of not want to break things too much, but might sacrifice just higher prices for the rest of us at the same time. So if that's not a recession, fine, it's not a recession, but it's not, you know, growth either.
Yeah, you make a good point because it's about the announcement. It's about the, you know, whether or not they call it one.
Yeah, the
And
NBER, right?
yeah,
Who pays
right.
attention
National
to
Bureau
them
of Economic Research. Yep.
unless, you know, unless they call something and then it ends up in a headline?
Right. Which is weird. I was saying, during that earlier period you described, I said, well, look, by this other definition of 2 quarters of negative GDP, we're there, right? This is a recession, but we never got the official call, right? We never got the official NBER call.
Because of
So,
the employment
right.
number at that point. However, that doesn't take into account the 40-year high inflation number, which, you know, put that in there and be like, oh, well, could that be the equivalent of some higher unemployment? I think so.
Yeah.
On
Yeah.
balance, if we're just
Probably.
talking about how people behave and the influence of, you know, spending decisions and that sort of thing and growth, you know, 40-year high inflation, of course it's recession.
Right. And yet here we are with consumer spending rising and all these things that, you know, in the Bloomberg article that we're talking about that have people pushing it out and pushing it out and pushing the announcement out and not saying there's a recession. So, and you're right. Like, does it matter? I wonder. Does it even matter? I don't know if it does. I mean, what matters is people getting up every day and living their lives and figuring out what to do. I think it matters for people who, like most people in the stock market, they don't hold on for a long time, right? They trade too much. So if they think there's going to be a recession in 3 months, maybe they're more bearish or they're not holding longer, whatever it is. Um, and maybe that's the only value of it. Obviously, if we do get a real brutal, 1980 sort of recession, that matters. We know that matters. Lots of people go out of work, things get really difficult, et cetera, et cetera. Um, but for now, like if we just, if they made this announcement tomorrow, I think the market would go,
Right.
eh.
I think most people
I
probably,
mean,
believe that we're. That's why I'm saying
and
the labeling doesn't. I try to ignore it, even though
yeah,
in what I'm writing, for our
I don't
daily
think anybody
digest,
would.
like I use it all the time because we're
Right.
talking about it, and it's what you can attach kind of a conversation to is the labeling, but there's too many kind of nuances to just apply one word, and this is why I always go back to what your goals are as an investor and what you're doing with your money, because that makes things so much easier when you're hearing all of these different things, whether it be are we in a recession or not, what will the impact of it be, all those, whatever it may be. It could be any topic. I mean, you go back to, it's easy to get caught up in the day-to-day stuff, and we talk about it all the time because it matters to a point, but it doesn't matter as much as what the goals are that a person may have for themselves. So it's a lot easier for me to just ignore these economists that if you lay them end to end around the world, that would be a scientific feat or something impressive. I don't know, but that's about it.
Right. So, I mean, recessions happen. Like if you're actually a truly long-term disciplined investor, you're going to hold through the recession anyway. You're probably going to keep buying. You're going to keep adding to your 401k. It's just that in the short term, things get scary. And, we've been in a bear market, technically speaking, since, over a year now, in my opinion. Some people say otherwise, but until we hit a new high, I'm going to say we're still in a bear market.
Yeah, yeah. And listen,
And,
like we've had, our colleague Mike DeBias wrote in the digest recently, showing that also recessions, the correlation between them and the bottom of a bear market. Like a bear market bottoms usually like 20 or something weeks on average after the official recession starts. But again, that is kind of retroactive based on when the official recession is deemed. So the market might bottom before anybody says it's a recession. But then looking back on it, you'll be like, oh, the market bottomed in the middle of the recession. So in the present, you're better off just going with what you see and preparing your own portfolio and managing risk that way rather than relying on the labeling. That's why, I think we're still in a bear market too, unless we make those new highs. But
right. So I was going to say, I mean, I can understand like the shorter term orientation because bear markets are scary, recessions are scary, et cetera, et cetera. Inflation, higher rates, all this stuff. But, we've been there, like anybody who's been investing for, 20 or 30 or 40, well, maybe 20 isn't enough actually, like 30 or 40 years. If you're our age or my age, if you're in your 60s, you've seen it all. And you know that, this too shall pass. And that if you keep buying, you keep buying into a time of lower valuations, you're actually setting yourself up for higher returns. So I don't know. For that long-term person adding to the 401k, I don't see it. For traders, good luck. This has been sideways, awful, ratcheting, nowhere action. I mean, I've got this chart of S&P 500 in front of me. It looks sideways for a year, actually. It's just like, it's hardly anywhere in a year. So I understand the anxiety around this, but obviously economists so far have once again sort of overstated their case. They've predicted whatever it is, 11 of the last 5 recessions or something, and they're predicting another one. But I don't know. I think the focus there is misplaced, and I think if you want to think about macro stuff, you need to be like Brent Johnson was saying when we had him on the podcast. Don't be dogmatic. Don't take anything for granted. I showed in the Ferris report one issue recently. I just put a simple chart of recessions and the CPI together and said, look, prices can go up during the recession. Like the CPI was going up during these recessions. And I was like, that, and it was during the 70s, right? 70s and then 80. So, into the first part of those, it still looked like inflation, but it was technically a recession. So you never know how things are going to turn out. And the talk of recession, there's an underlying, like, I would know what to do kind of a thing. Oh, if it's a recession, well, then I know what to do.
Right.
Probably not.
Right. It's just is it just people wanting to feel better that there's a label on what we're living through rather than the uncertainty? I mean, that may be part of it too. And I was walking the dog, Dan, the other day, and I said to myself, wait a second, it's May, it's the middle of May already, and if you were completely on the sidelines of the market this year, we say you want some cash on hand, right? But I've also been saying own those high quality businesses that can, spew out dividends so you can compound over time too. So if you've been out it's already almost halfway through the year. And so if you're listening to these economists saying, oh, the recession's coming since over a year ago, and you've been believing that, okay. But what have you, like, what's the action you're taking based off of that? I mean, to me, like, if, like you were saying, like, you can be in this market, and if you're in like a great company, like a Coca-Cola or a Hershey or something, and you just hold on to that, it's going to benefit, depending on your timeline, 5 or, if you're talking long term, it's going to benefit you way past whenever this recession begins, ends, whoever says it is or isn't. So anyway, that was my profound thought while I was walking the dog the other day.
I feel like we owe our listener a takeaway here, because we've sort of been going around and around with this idea of a recession and economists, and maybe it doesn't matter. And I think you just said it. I think you're right. I think that's the takeaway. I think we're going to have you walk the dog regularly for takeaways.
Well, I do plenty of that.
Good. All right. So now that we know Corey's dog has been exercised, we can move on and talk with not one but 2 guests. I love these guys. I've been reading John Doody for decades, since the 90s. He's one of the first people I ever read, a newsletter by, and still one of the best. And I'm looking forward to talking with him and his partner, Garrett Goggin. Let's do that. Let's talk with him right now. With gold having recently hit a new all-time high, my viewers are wondering what's next for the price of gold. To answer this question, my colleague Daniela Cambone is sitting down with 2 of the smartest gold experts in the world for an exclusive new interview. In it, you'll hear their prediction for where gold is headed next, the good news and bad news for gold investors today, and perhaps most importantly, you'll get to see the inner workings of a powerful system for investing in gold. A system which has delivered audited returns of 706% for more than 2 decades, crushing the return of gold, the returns of major gold funds, and more than doubling the S&P 500. To be among the first viewers to see this exclusive new interview, head to www.goldrush23.com to sign up for a reminder of when we go live. Again, that's www.goldrush23.com to sign up for a big gold interview. All right. And with that, John, Garrett, welcome back to the show.
Nice to be back with you, Dan.
Thanks, Dan. Nice to be here.
Yeah. Hey, man, we got 2 guys this time. We're not fooling around. I wanted to talk, first of all, about just your general views on things. I do want to get to this top 10 list of yours, because I know you're all fired up about it. I read your recent report, and the first 100 words are like, this is a new bull market in gold. You must buy our top 10 stocks right away. So I know you're fired up, but maybe just for the sake of our listeners, John and Garrett, you could both sort of give me your overview about why, what are you so fired up about? Why are you really bullish on these stocks right now?
Well, from my perspective, it's 2008 all over again. The banks are in trouble. In 2008, they had bad mortgages that sank their balance sheets. Now it's bad bonds. And they all bought. It's not that the bonds are going to nothing. It's that the bonds are paying a 2% yield when they were bought a year or two ago, and now the market interest rates are 5%, and the banks have all gone. The bonds have all gone down in value, which is fine as long as nobody wants their money back. But if the depositors want their money back, the value is not there in the bonds. The bonds can be held by banks in a special class called hold to maturity, which means that the banks don't have to mark the bonds to market. And so if a bond is paying when it was bought, the $1,000 bond was paying 2% when it was bought a year or two ago, and now market interest rates are 5%. That $1,000 bond is now worth about $400. And if the bank is holding it in a hold to maturity account, though, then they don't have to take a hit on that value change from $1,000 to $400. But they do have to take a hit if they have to sell the bond in order to pay back the depositor. So I think that's got the banks in a tough shape. As long as they can hold on, fine. But and the big banks probably are always going to be fine. But it's the smaller banks like the Silicon Valley Bank that had that exact problem, that the bond portfolio was underwater. People wanted their money back, and they didn't have the money. They couldn't sell the bonds to get all the money back to them. So there goes the bank. So I don't know. What do you think, Garrett?
Yeah,
let's listen to Garrett.
the banks are having trouble because the Fed funds rate is too high. And you can see that the 10-year yield's declining. Fed funds rate is high right now. The economy's slowing down. And one of the things that we like to take a look at is the difference between the 10-year yield and the Fed funds rate. Right now, the Fed funds rate is 1.7% higher than the 10-year. This is the deepest discount ever, all the way back even through the 80s. It's only reached anywhere near these levels maybe 3 times since the year 2000. So this shows the economy slowing down. It shows the Fed funds rate is too high and that the Fed's going to have to start cutting rates soon. And every time this happened in the past, it's been a great signal for gold and gold stocks. And also the other thing that's going on right now is, Treasury cash, right? They're going to raise the debt ceiling. The Treasury only has $87 billion. They spend that in a day, basically. So as public debt outstanding goes up, the Federal Reserve balance sheet will continue higher also, and that has a pretty good correlation with gold as well.
Okay, so I want to go back to John. John, draw me a line from, banks are in trouble to gold. Is it simply that folks will be fearful of the banking system, so they'll withdraw cash and buy gold?
No, it's interest rates that affect gold price. And since gold doesn't have a yield, when interest rates are high, gold struggles, and when interest rates are low, gold does very well. And I think what's going to happen is the Fed is going to have to lower interest rates, and soon this year. And that'll be a signal. Every time that's happened in the past, the price of gold has taken off. And, we tracked this in the latest issue 5 different times that the Fed has lowered interest rates from, and just in this millennium, just from when Greenspan lowered rates when Bush came into office in 2001, the gold took off. So this is just going to be another time that gold taking off. And that means that gold stocks go up. The gold stocks are leveraged to the price of gold, so that they'll go up more than gold.
All right. Garrett, is it simply the correlation? You just like the correlation between that Treasury Fed fund spread and gold?
Well, what happens if you look at the dates that the curve was inverted by this much? There was financial calamity back in 2019, back in 2006, and back in 2000. Were tough financial periods. The Fed was forced to step in and support the markets with QE. They were, bailing out the banks, and we're seeing the same thing right now. The Fed's going to have to step in, buy more bank assets, and build their balance sheet back up.
All right. So I want to really get to the nitty gritty because, in my mind, just for our listeners, like John and Garrett really shine when they're talking their book about gold stocks. I mean, these guys rip apart gold companies. I'm telling you, I started reading John like decades ago, and I remember opening up Gold Stock Analyst and seeing those pages. And this was like I think this was when, things were kind of printed in a different way. It wasn't like we were all working off of laser printers and we were still mailing things out and stuff.
Yeah,
And
that's true.
I
First
looked
issue
at
was
the pages of,
1994.
yeah. So I looked at this issue, in the 1990s, and it just was so packed with data. I was like, whoa, man, this thing was overwhelming for each company too. There was all this data. And I was like, nobody does gold stocks the way this guy does. And, now you've got Garrett with you and you guys are in gold stocks and silver stocks. You're like my go-to place for information about these. And I know your top 10, that's for your readers of Gold Stock Analyst though, right? I mean,
Yeah,
are you comfortable talking about individual names
yeah,
or
no,
what?
we
What do you
are.
want to do?
We cover about 50 stocks that are gold miners, royalty companies, and silver miners, and we boil them down to a top 10 gold stocks and a favorite 5 silver stocks. And the reason we cover so many stocks is that's how you know where the value is. That's how you know what's undervalued and overvalued. When somebody writes, some other analyst, so-called, writes something is undervalued, well, how do they know that? We know it because we have the average valuations for market cap of ounce of reserves, market cap per ounce of production, or operating cash flow multiples. We know where the average of the market is now. When we say somebody's undervalued, we have the data to back it up. We're just not saying that as an adjective.
John, tell Dan about your process back in Nantucket, back in the day.
Back in the day, you mean before you came along?
Yep.
Yeah, well, it was a lot of number crunching, and Garrett made it all made the crunching a lot easier. But back then I was living on an island, Nantucket Island. There was no Kinko's, no Sir Speedy copy company. There was nothing, and there was no internet either. And we had to get information faxed to us by the companies, but I had 2 high-speed copy machines. 2 because if one broke down, I was out of business because the copy repair guy only came to the island one day a week. So I had to have 2, a backup, and so we would print the issue and on these copies. Then I had a folding stapling machine that would fold the pages and staple it in the middle, and then I'd get 2 high school kids that come in and on issue day, and we'd stuff and stamp and get them in get them out that night and take it down to the post office the next morning, and they would leave the island. So it was 2-day process just to print the issues. And when I moved to Fort Lauderdale in 2001, there was a Kinko's there, and they could do all that for me in 6 hours. So that gave me back a day and a half of my life every month.
And now, of course, everything is different. So I don't even know if we deliver hardcore copies of anything anymore.
No, we don't for us anymore.
All right, let's talk about stocks. I mean, are you, like I said, are you comfortable talking about an individual name from your top 10,
Yeah,
or
we'll talk about
would you rather not? Okay. What do you like?
Well, how many kids do you have, Dan?
3.
3, okay. Which is your favorite? No, we don't really have.
You don't have a favorite.
No, we don't really have a favorite, although maybe at certain times we think that some of the top 10, the top 10 are often in different stages. They all have feasibility studies, so we know the ounces are there. There's 90% of all gold stocks don't have a feasibility study. So it's just some guy with that arm waving around his company that would know it's all BS. It may be a feasibility study possible, but they haven't done the work yet. And that, go from just starting drilling to getting a feasibility study could be a 5 or 10 year process. So we only look at companies that have a feasibility study and or are in production. But there's various stages of that. Company could just be completing a feasibility study. Maybe they're going to be raising money now to build a mine, or trying to permit the mine. There's 2 or 3 years right there. So we try to get companies where at the stage that something might be happening to them, and sometimes that happening is itself a 2 or 3 year process. So it's hard to get, there's a Lassonde curve, which Pierre Lassonde coined. It's sort of like a laying down S. that company price that has the stock price on the vertical axis and time on the horizontal axis. And the stock price goes up early on when there's a lot of excitement about the stock, but there's really not a lot of information. There's certainly no mine. They may have to do the feasibility study and raise the money to build the mine. And when you get into that stage of raising money, building the mine, there's a 2 or 3 year period of time when not a lot of exciting stuff is happening. So often a company that's got good results, good project, they go into a doldrums for that 2 or 3 years. And then when they're building the mine, they raise the money, that's often an ideal time to get involved in the stock because they've taken a lot of the risk out. The study's done, the permits are in place, and they've raised the money. And the stock's just in the doldrums because there's nothing really exciting going on. But when they start getting ready to produce, then you've got some excitement. So you want to be in earlier before that period.
One of the things that we do by focusing on the whole industry too is we really get to know the management. There's good management and there's bad management. There's management that will have a good asset and they will waste it. They'll waste the money on bad purchases. There's a lot of dilution in this sector, a needless dilution where they issue shares every year because Canadian investors will get a tax write-off. So the share count goes up and investors get stuck with a smaller piece of the pie. However, there's other management that are shareholders in the company that benefit, that are aligned with shareholders, that make money when the share price goes up, aligned with shareholders. So these are the companies that we primarily like to focus on, the ones that, generate good shareholder value.
Yeah, mining companies generating good shareholder value. Like even just talking about it kind of makes me chuckle because the history of the industry is very poor in that regard.
Yeah, it's an oxymoron.
Yeah.
If you look at, people think silver and they think core mining. Core mining, it's silver gold. It's about 40% silver, 6% gold. Core mining was $300 a share back in the 90s. It's $3 a share now. It's down 97%. Why? Because they've issued so many shares over the past decade or so that the share price goes down like a triple leverage ETF. They have a tremendous amount of debt outstanding. They do, they hedge some of their production. And, as I like to say, banker's best friend is a shareholder's worst enemy. So some of these companies, are great deals for bankers. They're not good for shareholders. So we avoid companies like this.
So I'm going to assume that it's not in your top 10.
No. And that's a split adjusted. Core never sold at 300. It's just that you back out all the splits that they've done. You get to a $300 price 20 years ago.
Right.
And there's good companies out there too, no doubt. One of the silver companies that I follow very closely, Silvercrest Metals. Eric Fear built Silvercrest Mining, started with an open pit, went underground, built it for, 130 million capex. It ended up getting bought out by First Majestic, and he spun off his Las Chispas and created Silvercrest Metals. They just finished that project on time, on budget after all the COVID, cost increases, which was a great effort. It's extremely high grade mine, and they're coming out with production right now. Extremely, profitable, low costs, and good benefit for shareholders. So there's two sides to that coin.
And ultimately, value does out. The value, the companies that give shareholders value rise to the top. We help them because we identify them, but other people find them too. So
I feel like Garrett's Silvercrest example is, against all odds, it really is possible, and we really can show you which stocks these are.
Well, look at our rate. We, gold since gold was set free in 1971. The compound annual rate of growth of the gold price up to 2000 now is over 8% a year. 8%. The inflation rate is 4% over that period of time. So that's a 4% real rate of return. Where do you get that? Show me any non-interest earning asset that has given that kind of return over a 50-year period of time. It doesn't exist. Maybe diamonds, but there's no way to track the value of diamonds or land. It's gold is really the only one that can do that. Now, maybe, you can identify some stocks that have done that, but that's back testing. There's no back testing here. We're looking at gold at $35 an ounce in 1971 to $2,000 an ounce now. Same thing. It's proven itself, and the top 10 has outperformed gold price by a factor of double. In the last 20 years, the top 10 is up for an annual compound rate of growth of 10% a year, and it's higher than gold. So we're the only newsletter we know of in the world that's audited by an independent auditor that audits mutual funds and hedge funds and truly independent, not some. We don't claim, we don't make these claims. It's every trade. We don't. It's easy to make because we don't make many trades. 2-3 trades a year, basically. So it's a matter of subscribers simply follow what we suggest they do, and should reap the rewards.
Right. And what you're suggesting now is like these 10 are most attractive bet that you could make if you wanted to buy gold stocks. In other words, these are the most attractive, like risk to reward, value oriented kind of bet that you could make right now.
Well, these are real companies, real assets, not right. We vetted them, and in fact, Right now there's only 9 because we kicked a company out of the top 10.
I noticed
they have a good site. They said they were going to. They sold a lot of shares over the last couple of years and put it into the ground in terms of building the mine and whatever. And they were saying all along, well, when it's time to actually finance the mine and get into construction, we're going to do it all with debt. Well, it turned out the banks wouldn't give them the money now, so they had to sell half the company to a bigger company, Goldfields, and so they gave away half the upside. If they'd been able to do it as they promised for the last couple of years for debt, the stock price target price would be double what it is now. But since they gave away half the company, with good reason, but hedging their bet, the target price on only half the share, on half the company, half the mine, is half of what it was when it was earlier. So we took it off the top 10. They misled us, and it's still going to be a successful mine, I'm sure. But we look for at least a double, and the double isn't there anymore.
Right. That's Osisko Mining, just so people know what we're talking about. But that's Osisko Mining. I have experience with Osisko Gold Royalties, and I wound up selling it because I was warned that the business model is kind of fluid. You never quite know what they're going to do next, and I didn't heed that warning, and I wound up selling because of that exact problem.
Yeah, well, they've gone in a couple of different directions, different from what the normal royalty company has done, and they wanted to be a royalty developing company, and that model doesn't work. Investors want royalties; they don't want to be. If you want a developing company, buy a miner.
Yeah, well, I mean, certainly like royalty, and we know royalty investment and royalty creation works, right? A company like Altius Minerals or something, but yeah, that development thing that costs money, and you wind up focused on large projects, and that's super risky and expensive. That's when you get into selling shares that you didn't plan on selling and all that.
What happens with the larger miners is the management will grow the company from 1 million ounces of production to 2 million ounces of production to 3 million ounces of production, but they're not generating any extra profits on a per share basis, So they're reaching their, threshold for getting their bonuses. So, they keep on getting increase in payments, but the shareholders get a smaller piece of the pie every time. So you really need to be focused on economics on a per share basis, whether it's profits or free cash flow or NAV. You need to be looking at companies that can do this. And it's hard. It's hard to do in the mining industry, but, we find the ones that do.
Okay. Do you mind if we talk about another specific name that is still in the top 10?
Sure.
Okay. Let's just talk about Franco-Nevada, since, that's like the big one. Of course, that's a high quality company, but do you think the returns are really going to be there?
Well, they've outperformed everything since their IPO in 2007 or whatever it is. And I could remember that for a while they were owned by Newmont. They were a public company, smaller, then bought by Newmont, and then they didn't really fit in the long term with Newmont, and they IPO'd back out of Newmont. I don't know, 2010 or something like that. And since then, they call themselves the gold investment that works, and it's true. They've outperformed everything. So yes, can they keep growing? Maybe not quite at the rate that they have in the past, but they're going to grow faster than the gold price, and because they've still got the leverage to gold price. And I think that we don't look for them to. I think our target on them is 200 US, and it trades around 150 US now. So that's still a pretty good return on your investment, and there's a lot of stability in that. We like to have some stable companies that are maybe less risky than. We don't like to think any of our stocks are risky, but maybe there's a lower risk of profile to a big royalty company like royalty that Franco than a single mine developer like Osisko was. So yeah, we think the upside is still there.
Yeah, and also we've been collecting the metrics for the gold stocks. John has, and I, all the way back to 2002. In 2002, the price of gold was $341 an ounce. The average cash cost was $183 an ounce to get an ounce out of the ground. Now, with the gold price at about $2,000 an ounce, cost the miners about $900 an ounce cash cost to get an ounce of gold out of the ground. So basically, cash costs have gone up almost as much as the gold price. The margins has been relatively constant, ranging between 40% and 60%, and that's what a lot of these miners trade off. If you look at royalty companies lock in costs, right? Like they'll sign a contract. They're like, we're paying you this much money now. You're giving us 1%. We'll give you, maybe an ongoing payment as well. But they're basically locking in their contract. So as the price of gold goes up, their margins continue expanding. And then the royalty companies are structured to get lucky. They've got hundreds of royalties. All they need is one to do well, and the other 99 could not do well, and the royalty company is going to do well. So, there's some inherent benefits to royalties over, the mining business, but the miners are extremely leveraged. The royalty business takes time to, grow, whereas miners, if they get it going in the right direction, they offer tremendous leverage at the gold price.
I love that you guys publish a long-term target price 2 to 3 years out for all of these stocks. And I noticed like some of them are trading sort of near their target price, but some of them are like, the target is 75 and the stock is 15. And you're talking 2 to 3 years out. I mean, that's not a long time, for a 5-bagger.
Well, it could be the mine needs to get built or come online or whatever. It could be something. These stocks can double overnight. As you know, and so it's not necessarily that far away, given how the stocks can react to either what they're doing themselves or what the gold price is doing. Although we don't base our target prices based upon gold. We're using a $2,000 target price now. That's what we assume is going to be the price in 2 or 3 years out when we set the target price. But the 2 or 3 years gives the company time to get to get the stuff done that it needs to do to get to the target price.
I see. So besides the current price of gold, what else goes into that target price calculation?
It's really a multiple of operating cash flow. So stock has to be in production, based upon its feasibility study or whatever plans that they've shown us, and it's pretty simple.
And we look at the high margin companies. Companies with low cash costs leading to high margins. The number one factor leading to low cash costs is grade. Grade is the denominator in the cash cost equation. So if you're mining a ton of ore, you want the highest grade possible. So your costs remain relatively constant, whereas your production is larger down the bottom. So your cash costs are lower, your margins are higher. It generates operating cash flow. It generates free cash flow. Companies use that to issue dividends. They use that to buy back shares. They use it for accretive acquisitions. Those are the sort of companies we look for. And the other companies, the companies with lower grade mines that aren't as profitable, they've got balance sheet gaps, and they're forced to issue shares constantly year after year in order to, pay management salaries for these, lifestyle mineral companies.
No, you guys are good. I'm listening and learning here. And I do want to ask one thing, going back to going back to your outlook for the Fed to cut rates in the second half of this year, and that benefiting the gold price. If inflation, I want to ask you about the inflation side of it. If inflation is where it is, or higher than maybe other people think, at that point, what will that do for gold as well?
Well, it'll probably send it higher, but we think inflation is on a glide slope down, and that's what the data shows us anyway. But inflation doesn't change dramatically from 1 month to another. It changes over a couple of years. So we're going to be in a high. We're not going to get to 2% inflation if we ever get there again. We're not going to happen in 2 months. It's a 2-year or longer process. And so we're going to be dealing with inflation in the news and impacting investors' expectations, and maybe we'll even end up with a 3% target price for Fed for inflation rate. If you can't get to where your target is, change your target, right?
Gee, move the goalpost. Yeah, that's exactly what I said to Dan last week on the show. Was eventually we'll get to a point where they say, oh, it's at 3 or 3.5, and that's good enough, right? Yeah,
that's good enough. Yeah.
And the CPI they look at is year-over-year change, right? So we had our big spike during COVID, right, where inflation was moving at a tremendous rate, and now as we go further out, we're going to be comparing it to a period a year ago where you had that inflation spike. Food prices rose a tremendous amount; they're not going lower, so we're at an elevated plateau. So it'll the inflation CPI headline number might show, low numbers, but it'll be a big change from 3 years ago, but not a big change from 1 year ago. So,
and what I love about that is what you're talking about before. You're talking about margins, right? And relative to the dollar and inflation. I mean that, right? To say it in Dan's words, draw a line from inflation to higher prices for gold in the gold companies.
Right. So I don't know if I like the point about inflation versus expectations of Fed cutting, but I'm not married to any one idea. Like if gold and the dollar rise together, the dollar is priced in other currencies, and what if it just is outperforming them while gold is rising? Like that can happen. We've seen it happen before. So I mean, I heard you, Corey, on that asking that question. And I was like, yeah. What about inflation if it stays higher for longer? But I think gold has become appealing for a number of reasons these days. John pointed to the banks,
and look at that. Look at the track record: 8% compounded a year for 50 years. In terms of the price change, that didn't.
I'm glad you mentioned that, John, because a lot of people probably don't think it means anything. Well, you're looking 50, or 20 years or 30 or 50 or however many years it is in the past, because it's beat stocks in the 21st century and it's done great since 1971. Why does that matter? Why does that long-term track record matter?
Well, that's where you want to be invested. It's proven itself over the years.
And also the flip side of that is the purchasing power of the U.S. dollar, right, which has steadily declined year after year over the past 100 years. So as the dollar goes down, it purchases less and less. Gold's been on the other side of that, going higher and higher. And that trend's accelerating right now with the amount of debt that's outstanding, the amount, how they're going to increase, the public debt outstanding, the treasury's going to spend more money, and the government's getting bigger, and it's increasing.
Yeah, and unfortunately, they're not like co-joined twins that they have to move together all the time. That they're going to have some independence from each other, but over time, what we're looking at is that how the trend has worked out: 8% a year compounded over 50 years, and 9%, I think, for this millennium.
Yeah. Yep, better than stocks. I want to go back to talking about companies. I said before the idea of gold stocks, generating like good shareholder value is like crazy, and you kind of agreed with me. But specifically, gold companies generated zero free cash flow like over a long, long period. But things have changed, haven't they? They're a lot better at that now as a group. Why is that?
Well, they finally heard stockholders complaining. Stockholders want dividends. They want. If you can't give me growth, Mr. Manager, give me dividends. And there are some companies that pay 3% dividend now, which is pretty good.
And
gold producing companies you're talking.
These companies, Barrick Gold was almost bankrupt. A decade ago? When Ty Burt, the CEO of Kinross, paid $3.1 billion for Redback and Tasiast, that marked the top of the market back over a decade ago. These companies had a tremendous amount of debt. They weren't generating much cash. Their debt was downgraded. They were on the verge of bankruptcy. So then they hired, good CEOs that managed the balance sheet. They cut back their liabilities. They reduced their debt, over the past decade. And these companies they're lean and mean now. And they have the ability, then they are generating, good operating cash flow and free cash flow, and they're paying dividends and they're buying back shares. They're doing the right things with shareholder capital and not blowing it like they did last time.
Right. What about the prospects for exploration? I mean, in all kinds of metals, they just haven't been making big finds in the past several years. They haven't found big deposits in the past 7 years. How has it gone for gold that way?
Pretty similar. It's a lot of the ounces that are mined today were known about 10 or 20 years ago, but they didn't make sense to mine them at $300 an ounce. But at $2,000 an ounce, it makes a lot of sense. So the rising prices of all metals is going to make more stuff that's in the ground still economic to mine now. So that's going to be true for lithium or any commodity you want to mention. So at some point, we know there's millions and millions and millions of gold ounces dissolved in the ocean, but it's so the grade is so low it doesn't make any sense. But maybe at $10,000 an ounce gold, it'll make sense for some of this gold to be recovered from the ocean. So it's price determined as much as anything. And some big mines that were shut in around 2000 are now huge mines producing now. There's the Detour mine and the Malartic mine, both of them owned by Agnico Eagle. They're both 700,000 ounce a year mines. These are big mines with 20 or 30 million ounces of reserves at these prices. But they were both shut in 2000 because they couldn't make any money at $200 or $300 an ounce gold. So it's really price dependent. Just when a mine is depleted, it's not depleted. It's depleted at the current gold price. And lots of mines have started back up because the gold price has gone higher.
And
that really is the point, isn't it, John? That it's people talk about the scarcity of these things, and you think, well, yeah, at current prices, maybe, but
yeah,
they get a lot. It's funny how things get a lot less scarce when the price doubles and triples.
Right. And if that falls hand in hand with the average grade of gold mines over the past, say, 100 years. Back in the day, you used to find it at surface. A gold vein, because you could identify it. You mine it right there. It's 50 grams a ton, and then you start getting it down deeper, and then it falls to maybe 20 grams a ton. All that easy stuff gets mined out during the last gold rush, and now we're left with 1-2 gram a ton material. So I would think that's the average grade right now. And then if the price of gold goes to $4,000, then it'll probably be profitable to mine half a gram gold.
Yeah. Of course, the classic example is like South Africa, right? I mean, they found it by tripping over it on the surface, and now they're a mile or two in the ground or something, or 2 miles.
Yeah, and they're mining so deep, and it's so dangerous at those levels. But there's, and maybe they'll reach some point of depletion, or some point at which the miners can't sacrifice miners anymore to get it out. That they'll stop, but they're still mining it.
All right. I think it's time for my final question, actually. We've been talking for a while. It's gone by so fast. And so I've got two folks for the final question. This is great. We normally only have one guest. So I'll ask each of you, whoever wants to go first, if you could leave our listeners with a single thought today, what would it be?
I would say it's 2008 all over again. The banks got in trouble in 2008 because of their bad home loans and defaults on the mortgages, and to people, they extended the credit to everybody to buy a house. Now it's a different problem. It's the bank balance sheets that are in problems because they bought too much debt, too much treasury debt, even the safest debt you could own. But they bought it in the last couple of years when they thought they were buying safe investments. They were safe if interest rates didn't change. But now that interest rates are significantly higher, that debt, that treasuries that they bought, they've been cut in half in terms of value. And I think that unless the Fed has to just like the Fed rescued the banks with QE after the home price crash in 2008. They're going to have to come up with QZ or whatever it is to rescue the banks now. We can't have small banks. Small banks are the lifeblood of the economy, and if they're all going to go broke, then we're not going to live in a J.P. Morgan world where that's the only bank, I'm sure. So that's my advice. Protect yourself.
All right.
Don't have more than $250,000 in your bank account. Who has that much anyway in the bank? And be in gold, and even better, the top 10.
All right, Garrett.
Yeah, for me, it's inevitable gold's going to go higher over the long run. And my major advice to people listening is stay away from low-grade cow pastures. There's a study by Archie Bell, who was the head of exploration in Miranda back in the 30s. And what he did, he was a back of the envelope calculation to find profitable mines. And what you needed to do is to recover twice your operating cost. And then if you move the grade around, it's easy you need to find high grade deposits that are economic. When people have economic models, it's easy to move your silver price up to 30 and 50. But what people don't do, they don't change their costs. Inflation's pushing silver and gold higher. Inflation's going to push your costs higher. So a lot of these low grade, uneconomic, pie in the sky mines appear to be good investments when the silver price is at 30 and 50, but they're not. You need to find the high grade ones. You need to find the ones that are profitable now. And the unprofitable, these lower grade ones that are unprofitable now, they're going to have to continue to fill those holes in their balance sheet so that when the price of silver finally spikes, there's going to be so many shares outstanding, the stock's not even going to move that much. So stick to good companies with good management with good high grade deposits.
All right, sounds good. Listen, thanks, John and Garrett, for being here. I always enjoy talking with you guys.
Good, Dan.
Yeah, we enjoy being with you, Dan. Thank you.
Nice to see you.
Thanks,
Corey.
You bet. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. And he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. As a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. If you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at www.rollingcrash23.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company C Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap Inc. before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to www.rollingcrash23.com for your free copy of this new report. That was great. I love talking to those two guys because rather than just making general comments about gold, they can get nitty-gritty on gold companies, and it's nice to hear. It's not something everybody knows. It's something very few people know well, and they're two of the best in the world at it, frankly. So it was really great to hear that. I love hearing John Doody talk because I've been reading his stuff since the 90s, man, and it's just good to catch up with him. What was your takeaway from that, Corey?
Yeah, similarly, I would say, if you haven't heard John or Garrett talk before about this sort of stuff, that is them. What you just heard, and I'm glad you asked a lot of different questions about the companies, because that really is what their newsletter is all about, and what separates the work they do, as you were saying, from pretty much everybody else. And so To me, a lot of what they were talking about also just reinforce this idea to me, and that's why I asked about inflation, was real assets and like why they can still matter and why they are valuable in this age of fake everything else and almost everything else in finance. Yeah, I mean, they're talking about margins, the dollar, the grade of the material in the ground, and why that separates the good companies from the not so good companies, and how they're able to arrive at the ones that are good. They're talking to actual real people too, like the management companies and that sort of thing. So yeah, if you're at all interested in gold stocks or silver stocks and you're not reading their stuff, I don't know what to tell you.
Yeah. Yep. I hear people say they're interested in gold stocks, and I'm like, oh, so of course you read Gold Stock Analyst. You know who John Doody and Garrett Goggin are. Nope, I never heard of them. I'm like, dude, you're missing out. You need to get on the stick. And they're going to give a presentation. They're going to do an interview with our colleague and fellow podcaster, Daniela Cambone. You can go to goldrush23.com and sign up for that and get a reminder when it drops on May the 23rd. And I would do it. Like, if you're at all interested in gold stocks, you just need to keep John and Garrett on your radar at all times. So go to goldrush23.com and sign up for the presentation and get online May 23rd and watch it. Watch the interview with Daniela Cambone. Like I said, if you're into gold and gold stocks, you can't miss it. It's not that, oh, it's the greatest thing in the world. It is the greatest thing in the world because you cannot literally afford to miss it. And one more time, that's goldrush23.com. Check that out. All right. Well, I really enjoyed that. I think Corey did, and I hope you did too. That's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it all as much as we did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. Do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_Hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.